You've probably heard it before. Don't panic, the market always recovers. But let's be honest, when your portfolio's down 45%, your favorite stock just tanked, and your so-called safe ETF is bleeding red, you start to question everything. Here's the scary truth. The stock market will crash, again, probably sooner than most people think. And while that might send chills down your spine, what if I told you it doesn't have to be a bad thing? In fact, if you play it right, it could be the greatest opportunity of your lifetime. I've been investing for over 30 years. I've watched Black Monday, the dot-com implosion, the 2008 financial collapse, and that little nightmare we called 2020. And here's the kicker. I came out wealthier every single time. So in this video, I'm revealing the exact strategies I've used to profit through every single crash. I'm not a financial advisor, but I have been in the trenches, seen the market burn, and found ways to rise above it all. And what I'm about to tell you could change how you see investing forever. Oh, and before we start, don't forget to like this video, hit subscribe, and ring that notification bell. Welcome to Market Reflect. Let's start by looking under the hood of how crashes actually happen. Here's what most people get wrong. Not all crashes are created equal. There are actually 3 levels of market pain. First up, corrections. These are your run-of-the-mill ouch moments, around a 10% drop from recent highs. They usually happen every 1.2 years since 1980. Think of them as the market's way of saying, hey, I got a bit too excited. Let's tone things down. Then we've got bear markets. These are nastier, drops over 20%. On average, they rear their ugly head every 4 years and 8 months. And when they show up, they stick around. On average, 290 days of consistent bloodshed. That's more than 9 months of stomach-turning volatility. But the rarest and most dangerous is what I call a collapse. This is when the market free falls over 30% in a very short time. These are the moments you remember forever. And while rare, they can happen when the world is on edge. The main takeaway? If you're not mentally prepared for drops like this, you probably shouldn't be in stocks at all. But if you are, here's where it gets fun. Let's talk about the euphoria phase. This is the calm before the storm, or rather the party before the hangover. Everything feels great. Stocks are climbing, everyone's making money. You start hearing your Uber driver talk about crypto, your dentist is flipping NFTs, and random kids are buying JPEGs for millions of dollars. Sound familiar? That's when I start getting nervous. Because here's the thing. Right before the 2008 crash, I saw it happening in real time. People were spending like crazy. Credit was too easy. Banks were handing out loans like Halloween candy. And when the music stopped, the fallout was brutal. Most people ignored the signs. I didn't. I started quietly pulling back, preparing my portfolio like a squirrel before winter. First thing I did, cut my risk. I'm not into chasing rocket ship stocks. I'd rather be the tortoise than the hare. Slow, boring, consistent growth that compounds year after year. Second, I made sure I had no leverage. Zero. Nada. Because when the crash comes and you're using margin, your broker can margin call you. That means they start selling off your stocks at rock bottom prices to recover the debt you owe. That's how millionaires go broke overnight, and I've seen it happen. Next, I started stacking cash. Not just an emergency fund, but way more. I parked it in high-yield savings accounts. Oh, and you want to hear what I really did that made people think I'd lost it? I diversified, hard. Everyone else was putting all their money into a couple hot stocks, Tesla, GameStop, whatever was trending. But I spread my money across entire sectors. Total US stock market funds, baby. If Tesla got crushed, I was still covered. Because here's the truth. Nobody tells you it's not about finding the moonshot. It's about surviving the crash. All right, now we hit the reckoning phase. This is when the market smacks everyone in the face with reality. Prices fall fast. People panic. Your neighbor who swore he was a long-term investor suddenly sells everything just to be safe. Remember 2008? My hobby store customers vanished. Dollar stores exploded across the country. People weren't just broke, they were terrified. This phase, it separates the amateurs from the builders. And here's where most investors blow it. They panic sell. They try to time the bottom. But if you miss just 5 of the best trading days between 1980 and 2022, that $10,000 investment would have grown to $671,000 instead of over $1 million. Miss 50 of the best days? You're down to $76,000. That's heartbreaking. Want a real story? Peter Lynch, legendary investor, bought Kaiser Industries when it looked like it was circling the drain. The stock dropped under $10. He held anyway. It later shot up to $50. But here's the catch. He understood the fundamentals. The company had no debt. It wasn't going bankrupt. That's why he held. If you're just throwing money into things you don't understand, then yeah, you'll probably sell the moment they fall. Instead, during this phase, I go hunting. In 2008, I wasn't running scared, I was buying. Stocks, real estate, entire businesses. I knew I couldn't time the bottom. So I used dollar cost averaging. Every week, I'd buy more. Didn't matter if the market was still dropping. I was buying quality assets for pennies on the dollar. That's why I always keep a side hustle. Extra cash during a downturn is your superpower. The more you can invest while others are panicking, the wealthier you'll be on the other side. And yes, there are folks who short the market too, betting it'll go down. Michael Burry, the guy from The Big Short, made a fortune doing this in 2008. Not my style, but hey, it works if you know what you're doing. Finally, we get to the Phoenix phase. This is the comeback, the quiet rebuild, the rise from the ashes. 4 years after the 2008 collapse, just after the London Olympics, I started to see signs of life. People were getting jobs, cash was flowing again. But even then, spending didn't return to normal for another 4 years. The psychological scars of a crash run deep. But here's what I've learned after living through all of them. Bull markets are born in the ruins of bear markets. You won't see the rebound if you panic early. But if you're buying consistently, diversifying, reinvesting, staying liquid, you'll be positioned better than 90% of investors. Most people fear a recession. I look forward to it, because the seeds of wealth, they're always planted in chaos. If you had an extra $10,000 during a crash, would you buy more stocks, start a side hustle, or stash it in a high-yield savings account? Drop your game plan in the comments. I'm curious to see who's playing offense and who's playing defense. And that's it for today. Hit the like button and subscribe to Market Reflect. Stay tuned for more and catch you at the next one.